Hello, hi guys. This is cabalakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we will be revising due diligence. This chapter basically it is a very small chapter. First of all, before entering into this chapter, let us understand what is meant by due diligence. Let me give you an example for this. Most of you people you might be knowing Shark Tank India. Basically, in Shark Tank India, entrepreneurs they will come to the show for raising some money for their businesses. Now the sharks, if they like the idea of the business, they will invest money into the business of the startup founder. Now before investing amount into the business, sharks they will conduct due diligence of the business of the that particular startup. Now on the Shark Tank show, the founders of the startup they will be presenting various facts related to their business to the founders. Based on those facts, founders will agree to invest certain amount, okay, will agree to give certain amount. But before actually giving that amount, sharks they will conduct a due diligence process of the business of this startup. Now in this due diligence, it will be checked whatever the information that has been presented by the founder is correct or not. Okay, the facts related to the business that has been presented, whether they are correct or not. And it will also be checked whether it is viable to invest into this business, and whether there are any hidden aspects, we will be calling them as deal killer defects. Okay, whether there are any such points, all of them they will be identified in due diligence process. Okay, and this due diligence process on behalf of sharks, that is on behalf of investors, it will be conducted by a professional. Mostly chartered accountants will conduct due diligence. Okay, however, apart from chartered accountants, if any other professional, if he is having ability to conduct the due diligence, if he is having knowledge to conduct the due diligence, he can conduct it. Okay, so due diligence is examination of potential investment. Okay, potential means the investment that you are going to make. Examination of potential investment to confirm all material facts of prospective business opportunity. And this due diligence can be conducted in the following situations. First of all, corporate restructuring. Now, in case of corporate restructuring, mostly creditors will forego some of their amount that is receivable from the company. Now, during this restructuring process, creditors they can ask for a due diligence of the company to be conducted on behalf of creditors. In the same way, venture capital financing. Whenever venture capital funds they invest any amount into the business, they also conduct due diligence. Lending, before giving any amount to the business, you will conduct due diligence. Leveraged buyouts. Basically, leveraged buyouts. Under this leveraged buyouts, a company will buy another company, but the funds that this company will use for buying another company will be mostly borrowed funds. Okay, if by utilizing borrowed funds a company purchases another company, then such type of purchase is known as leveraged buyout. Next, public offerings. Whenever you are going for a public issue, then also due diligence might be conducted against the business of the company. And disinvestments. So in these situations, the process of due diligence can be conducted against the business. Okay, next, importance of due diligence. Basically, the major reason for conducting due diligence is to identify, to confirm business is what it appears to be. Okay, what is actually shown to the investors, what the founder has actually communicated to the investors, whether that is true or not. Okay, what it appears from outside of the business, whether it is true or not, this will be identified in case of a due diligence. And also whether there are any potential deal killer defects. Okay, whether there are any issues in the company or business that will cause the investors, that will change the investors decision of not investing into the company, whether there are any such potential deal killer defects, even they will be identified. And gaining information for valuing and negotiating, for purpose of valuing the company, for purpose of deciding the consideration that has to be paid for investing into the company, what is the valuation of the company. In order to know this, you need to know the value of the assets, and the worth of the business. All this it will be identified in case of due diligence process. And verify that transaction complies with investment criteria. Investment criteria means investors, they might be having certain investment criteria, like the investment criteria of some of the investors might be they wanted to invest only in profit making companies, and they wanted to invest in only those companies where there are at least three co-founders. Like this, there might be certain investment criteria, whether the potential investment is fitting into the investment criteria or not, it will be verified. Okay, and you need to remember that due diligence is not audit. Due diligence is completely different from audit. Hope that is clear. Next, classification of due diligence. There are various types of due diligence. Firstly, we will be having commercial or operational due diligence. Under this commercial due diligence, the basic thing that will be checked is whether investing in particular company is viable or not, whether investing in particular company will create any operational synergies or not. This will be the main agenda of this commercial or operational due diligence. Once commercial or operational due diligence is conducted, next you will be conducting financial due diligence. In this financial due diligence, you will be going through all the financial aspects of the company. Next, you will conduct tax due diligence. Because of this investment, what will be the tax implications, and whether there are any tax dues, okay, pending tax litigations against the company. All these aspects with respect to tax will be taken care in case of tax due diligence. And information system due diligence, which will be related to technology that the company is using. And legal due diligence and environmental due diligence. These are various types of due diligence. Next, general points that will be verified in case of a due diligence. You can just change it as general points to be verified in due diligence. Okay, in case of a due diligence, what will be the general aspects that you will look into? First of all, you will see the history of business of the company. Next, you will check the background verification of the promoters of the company. Next, what are the accounting policies that the company is following, and from where management is getting their information for taking day-to-day business decisions. That is, what are the management information systems, and what are the results of operations of the business. That is, trading results of the business will also be verified in case of a due diligence. And what is the management structure, how management structure is there in the company, this will be verified. And current status of various litigations with respect to tax matters, even this will be verified. And cash flow patterns, what are the cash flow patterns from where the entity is generating cash, even this will be verified in case of a due diligence. And finally, what is the future profitability of the entity, okay, whether the entity will be able to generate profits in the future, that is, projection of future profitability. These aspects will be verified in case of any type of, okay, in a general due diligence, these points you will verify. And coming to specifically financial due diligence, what will you verify? Now, in case of financial due diligence, you'll first of all go through into the history of the business and the background of the promoters, and you'll also review the financial statements of the company. And you'll also go through the accounting policies that the company is following, and you'll also look into taxation matters. Okay, even though for taxation there is a separate due diligence, tax due diligence, since this taxation matter is also one of the part of financial aspects of the company, financial due diligence will also cover taxation aspect. And next, cash flows, from where the company is generating cash flows, and financial projection, management and employee related aspects, and finally statutory compliances. These aspects you will verify in case of a financial due diligence. Okay, next, another important aspect that you will search or that you will try to find out in case of a due diligence assignment is whether there are any hidden liabilities in the organization. Hidden liabilities means those liabilities which the founders have not communicated to the investors. Whether there are any such hidden liabilities in the organization, you'll try to find out them, and whether there are any overvalued assets in the organization. Okay, these two aspects also you'll try to find out in case of a due diligence process. Now, what is meant by hidden liabilities? What are some of the examples of hidden liabilities? First of all, show cause notice that has matured into demand. Let's say, for example, income tax department, they have issued a show cause notice asking why we should not impose a penalty of 1 crore rupees on you. Okay, like this, a show cause notice has been issued. See, show cause notice, it is not a demand, it is just information that is sent to the company asking why income tax department should not impose this penalty. Okay, now for this notice the company needs to give response why the income tax department should not impose this penalty. For this, a response has to be given. So this is show cause notice. If income tax department is not satisfied with the response that is given by the company, then income tax department will issue a demand notice. Once the demand notice issued, then that becomes a liability on part of company. So whether there are any such show cause notices that have matured into demand notices and which are not communicated by the founders or which are not shown in the financial statements, you will try to find out whether there are any of these aspects. Next, LOC not disclosed in financial statements. LOC means letter of credit. Basically, these letter of credits, they are off balance sheet items. They will not be disclosed in the financial statements. They will not be accounted for in the financial statements, but you need to disclose that there is a this contingent liability of a letter of credit worth this much of value. Okay, letter of credit, it is a contingent liability. We have discussed this letter of credit concept in bank audit. Okay, next, product and other liability claims, like whether there are any warranty claims that are not disclosed in the financial statements. If yes, then that becomes a hidden liability. Next, tax liabilities under direct tax and indirect taxes, environmental and third party claims. Okay, whether there are any third party claims against the company and the company has not acknowledged them as due, in that case that becomes a contingent liability. And if this contingent liability has turned into liability, whether it has been properly accounted in the books of accounts or not, if not, that becomes a hidden liability. Next, agreement to buy back shares at a stated price. Now let's say company, it has raised some 1 crore rupees by issuing shares, but at the time of issuing the shares, one of the terms and conditions of this issue is that company has promised those shareholders to again repurchase those shares after 10 years at a price of, let's say, some 120 rupees. Now each share has been issued at 100 rupees, but after 10 years the same share, it will be bought back by the company at 120 rupees. Now this becomes a hidden liability if it is not properly disclosed in the financial statements. Okay, next, unresolved labor litigations and future lease liabilities. Basically, the future lease liabilities, you will not disclose them in the you will not account for them in the financial statements. You need to show it as a disclosure. If the disclosure has not been made properly, then that might become a hidden liability. Next, examples of overvalued assets. What could be examples of overvalued assets? Uncollectible receivables, that means bad debts or doubtful debts. If at all there are such doubtful debts or bad debts, you need to provide a proper provision. If the provision has not been provided and you are showing those uncollectible receivables at the same value, then that might become a overvalued asset. In the same way, obsolete inventory, that is being valued at net realizable value. Okay, obsolete inventory means it has become waste. The inventory has become waste. It is non-moving inventory. It is being uh, you know it is left with the company for a long period of time, then that becomes a obsolete inventory. These obsolete inventory needs to be generally written off, but instead of writing off, or it needs to be shown at a net realizable value. Instead of showing it as a net realizable value, you are showing it still at the cost basis only, then that becomes a overvalued asset. Next, litigated assets. If at all there is any litigation against the asset, then the value of that asset generally it will reduce. Let's say there is a land, Okay, against that land there is a litigation. You have purchased that land at 2 crore rupees. Since there is litigation with respect to that land, no other buyer will be willing to purchase that land, so automatically the value of that land reduces because of litigation. So you need to reduce the valuation of land in the books of accounts also, but without reducing it you are still carrying it at the market value or the cost that you have incurred for purchasing it, which becomes a overvalued asset. Next, investment carried at cost through realizable value is much lower. Okay, investments you need to measure them at cost or realizable value, whichever is lower. Instead of, even though the realizable value is much lower, you are still carrying the investment at cost only, that becomes again a overvalued asset. Next, investment carrying lower rate of return. If the rate of return that you are generating on investment has reduced, then proportionately you should reduce the valuation of that investment also. Okay, basically this will happen in case of debt securities. Next, intangible assets of no value. If there is no value for the intangible asset, why you are recognizing them in the books of accounts? You should not recognize them in the books of accounts, since there is no value for them. Group company balances under reconciliation. These are some of the examples of overvalued assets. Next, matters to be checked regarding cash flows. With respect to cash flows, you need to check whether the company is able to honor its commitments, whether the company is able to repay its liabilities or not. Next, how well company is able to turn its receivables and inventories. Okay, how well the company is able to turn receivables and inventories into cash, and how well it deploys its funds. Are there any ideal funds that are available with the entity, and what is the investment pattern of the company, and are they easily realizable? Okay, the investments that the company has made, whether they are easily realizable or not. Next, work approach to due diligence. Generally, in case of due diligence, you will first of all review the financials that are submitted by the target company. After reviewing the financials, you will also perform a on-site visit. Okay, first you will assess the business first hand by a site visit. Then during that site visit, you will conduct the due diligence process and prepare offer based on completion of the due diligence. Next, how to conduct due diligence. Here you please strike off this chart and note down this chart. How to conduct due diligence? First of all, you need to start with a open mind. You should not start the due diligence with a mindset that there will be some mistakes, there will be some frauds, we need to find out those frauds. No, you need to start with a open mind and identify trouble spots and ask ask the explanations for those trouble spots, and get the best team of people for conducting due diligence. And wherever possible, you take help of other people for various areas, because in due diligence you need to conduct due diligence in almost 360 degrees of the company, so you might not be having knowledge about all the aspects of the company. So wherever you are not having knowledge, you can take help of other experts and talk to customers of the company, suppliers of the company, employees of the company, and business partners of the company. You will get some information in this, and take a risk management approach. Wherever the risk is high, you focus more in that area and prepare a comprehensive report based on your due diligence. So this is how you will be conducting a due diligence, and once the due diligence has been conducted, you will be issuing a report, right? However, there is no a particular format for this due diligence report, but a illustrative points that needs to be present in a due diligence report are: firstly, there will be a executive summary, that is summary of entire report, then introduction, background of the company, what is objective of this due diligence, and terms and scope of this due diligence, and what is the shareholding pattern of the company under due diligence. And you will give assessment of various financial liabilities of the company, valuation of assets, trading results, that is operating results, and statutory liabilities and net worth of the company. You'll also comment on future projection, future profitability, what will be the cash flows in future. So you'll comment on the future projections. SWOT analysis you'll perform, that is strength, weakness, opportunity, and threat analysis. And finally, suggestions on steps care to be taken before and after the merger. Okay, here you need to strike off on suggestions on care to be taken before and after the merger. Okay, if at all the transaction is merger transaction, if you are conducting due diligence for a merger transaction, then what care need to be taken before merger and after merger, even that aspect you will discuss in your report. Okay, so this is complete revision of due diligence chapter, and you can download this chart from the link that I will be providing you in the description. And if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. And in place of this chart, you please note down this chart. Okay, you can just take a screenshot and you can note it down. I'll be winding up this video as of now. Take care, bye bye, see you.